All right, so today I wanted to make a video on the Yield Max ETFs. These ETFs have become very popular because they pay very high dividends. First things first, I want to mention though, if you get value out of the video, please like, subscribe, comment, check out those links below. Always appreciate the support. So like I said, these pay very high dividends. Now, what a lot of people say about these as a criticism is the share price is down, or you shouldn't invest because the share price is down. And I think that that's a good criticism in some ways, but at the end of the day, the whole point of these ETFs is to pay high dividends. So whenever you have an asset that the whole goal of it is to pay dividends, you have to take into account reinvesting dividends in your returns, right? Because nobody would say you shouldn't buy T-bills because T-bills get zero return, right? You don't get any capital appreciation in investing in T-bills. Like, no one says that. Because the whole point of T-bills is, number one, you're getting it for the stability, and number two, there is a payout, right? There is a yield. So it's just either misleading or just outright dishonesty to say you shouldn't buy these ETFs because they don't pay a dividend, or the share prices lose value per se. So let's get right into it. TSLY is very common, but I don't own it because it's underperformed the S&P, right? So my whole criteria for investing in these is if they underperform the S&P, I don't buy them, because number one, the whole point of buying any asset other than the S&P, at least to some degree, is you want it to outperform, because if it's going to outperform the main index, you might as well just buy the main index, because it's going to be less stressful and you're going to get better returns. So that's my first criteria, is I want it to be outperforming the S&P. Right? That's my first criteria. That's basically the only important one. The other one obviously is you want it to pay a good dividend, but every single one of these pays a double-digit dividend, at least of the ones I've looked at. So I don't own TSLY because it's underperforming. I don't own this one. I don't own APLY, which is the Apple one. I do own NVDY, which is the NVIDIA one. As you can see here, they're actually outperforming the S&P basically over the last 2 years by a lot. Even the last year, it's still outperformed. So, like I said, you look at this, right? The actual share price is down quite significantly, but the overall returns are outperforming the S&P. So I do own NVDY. And the other thing I point out here is that, in my opinion, it's probably a good idea to diversify between these, because these typically run synthetic covered call strategies. And with these sort of strategies, it's inevitable that the share price will, unless the stock continues to go up like 20-30% per year, which, let's face it, no company's going to do that. You will lose value from the share price. So that's why I think it's important to diversify, and it's also important to, when they start to underperform, to sell, because some of these have lost a lot of value, even with at least compared to the S&P, even with reinvesting dividends. So I do like NVDY, but you also have to keep in mind that NVIDIA is a very volatile stock. So it could go down 50%, and that wouldn't be surprising. And this would probably go down more. So be careful is all I'm saying. AMZY I also own. If we look at AMZY, another thing too is that you really want to like the underlying, right? One of the most important things with covered call funds is you have to like the underlying, because that's going to be the main driver of the returns. AMZY also has outperformed the S&P. If we go back a year, it's almost exactly the same actually. Over the last 2 years, it's outperformed. The next one is FBY, which is obviously Facebook or Meta. If we look at this one again, going back a couple years, it's outperformed by quite a bit. Going back about a year, it's actually outperformed rather easily. So this is one that's actually outperformed rather easily. GOOY, I don't own that one. I don't own the Coinbase one. I don't own the Netflix one. I don't own the Disney one. I do own the Microsoft one. to be quite honest, the ones I own pretty much are the ones that outperform the S&P, right? I'm going to be pretty straight up with that. Over the last couple of years, it's outperformed. Over the last year, let's see where we are at. It's actually slightly underperformed, right? It's actually slightly underperformed. So this is going to be one that I'm going to watch closely, especially because, I mean, the Microsoft stock has actually done pretty well. I mean, over the last year, I don't think they're up massively, but at least over the last 2 or 3 years, they've done very well. So this is one I'm going to keep watching. This is one I'm going to be watching very close, because even if we go back almost 2 years, they're actually just slightly outperforming the S&P. So this is one I definitely will be watching close, because of all of the ones I've mentioned, this one looks like it's one of the ones that's underperformed the most, but they are still beating the S&P. So the next one here, as I scroll down, obviously is MSTY. This is by far my largest position out of any of these, because I think that MSTR is the most underrated company in the stock market right now. Now, it is also one of the most volatile companies, so I'm not saying that necessarily means you're going to get rich off of it, but I mean, if we go back a year, it's up 116%. The S&P is up just under 14%. So it's absolutely destroying the S&P. Even year to date, I think it is as well. Let's see. Yes, even year to date, it's up 13%. The S&P is up 4%. So a lot of people say, hey, the share price is down 26%, but when you account for dividends, it's well outperforming. So again, you have to keep in mind that if you're going to invest in these, you're going to have to be able to stomach negative price returns, at least as far as the share price goes. You're going to have to stomach that, but you have to keep an eye. When you include for dividends, are they outperforming? So the next one here is going to be, I actually do own a little bit of the Alibaba one, which is BABO. I don't own any Alibaba actual shares, but again, you look at this one. Number one, it's a way to diversify, but number two, it has outperformed the S&P over the last just under a year. So again, keep an eye on it. I mean, the share price is down 25%, but it is outperforming when you account for dividends. So, and it looks like that dividend's actually growing a little bit over time, which I very much do like that. So, I do like BABO, at least right now, but keep an eye on it. Like I say, you really want to keep an eye on these very closely, because they can turn quite quickly. TSLY, also another one that I like. This is also another way to diversify a little bit out of the States. They do have a lot of correlation to the U.S. stock market. Again, over the last year or so, it has outperformed. The next one is going to be PLTY. Now, this one, other than MSTY and this one have definitely been their best performing ones, maybe NVDY. This one's been around only since October of last year. They're up 115%. Even the share price is up 19%. Which is quite impressive considering the S&P is only up 8% over that time. So this is one I also own. I think this might actually be my second largest position of them, and this one's paying like a 60% dividend, which is really impressive. So there's not very many left here. GPTY is another one I own. This one actually pays weekly dividends, which is different than all of the rest of them. I do like them, partially because of the weekly dividends, but also because you look at them. This one actually came out back in January, so this one hasn't even been around it's only been around for about 6 months. It's up 7.5% when you account for dividends. The S&P is up 1.5%, so easily has outperformed the S&P. I think it's paying about a 35% dividend, so obviously very impressive there. If we continue to go down here, they just came out with these 0 DTE covered call funds. I don't own them because they've underperformed. CHPY is the semiconductor one. This one's very, very new. It's even newer than all of the other ones I've came out with. I'm watching this one closely, and I will buy it once we get a little bit. I might buy it. I wouldn't say I will buy it. I might buy it if it continues to perform well. And another one also on the watch list is BRKC, which is Berkshire. covered call fund. This one's been around for like a month, literally, so it has like no data on it. So long story short, the vast majority of these I don't think are worth buying, because yes, they pay good dividends. All of these pay very good dividends, but a lot of them, even the share price is just getting killed. Like, and even on some of these that are performing at least moderately well, like even MSTY, the share price is down, I believe, over the last year, right? If we look at MSTY, let's just double check them, because this is by far the biggest position I have. And even though you do have some potential negative price returns, I'm still fairly confident in them. Let's check on about a year. Share price is down 12%. But when you look at the drip, it's up 150%. So again, these are pure income plays. My plan, my whole reasoning for buying these funds is I want to be able to get enough money coming in every month that I don't need a job. That doesn't necessarily mean that I want to quit my job ASAP, but it does mean that I want to get to that point as soon as humanly possible. Now again, I don't want to take excess risk, but I think that these funds give you the ability to get to that point much faster. But you have to keep in mind that you don't want your principal to be, I mean, again, a little bit, I can live with that, but you don't want your principal to be destroyed in that process. So that is my thought process when it comes to the yield max funds. I'd love to hear other people's thoughts on the matter. But again, something to keep in mind is that if you look at the MSTY, dividend, if you wanted to get, let's say, $5,000 a month, right? $5,000 a month, and let's just use US dollars. So Canadian, that's going to be like 6 or 6,500. To get $5,000 a month, which is, you know, the equivalent to what, like an $80,000 a year salary, maybe even a little bit more after taxes, depending on where you live. But again, it's going to be roughly around there. To get that, you know, 70, 80,000, whatever the number, doesn't matter, doesn't have to be exact. You only need about 3,500 shares. 3,500 shares based on the current share price, just off the top of my head, would probably be a little bit over $100,000, right? So let's just say you have $100,000 laying around. You can get $5,000 a month for doing nothing, for doing absolutely nothing. And on top of that, you can sell covered calls on this fund, right? MSTY, at least on, you know, Interactive Brokers, at least for me, you can sell covered calls and you can get an extra 10 to 20% per year by doing that. And the importance of doing that, the reason I bring it up, not only is you can get a better return, but that if you turn around and reinvest that money, that will pretty much negate the negative share price, at least over the long run. In fact, it might even grow, because I think if Bitcoin goes to, you know, $150,000, $200,000 over the next year or even 6 months, MSTR probably is going to be up quite significantly, which means MSTY will probably be up less significantly, but it'll still be up. So the reason I mention is that selling covered calls on the covered call fund, I think that that's just an absolute genius way of going about it, because you can take all of that money you're getting from the dividends, you can reinvest the money you're getting from the calls, not from the dividends, and you can grow that pot over time without actually having to reinvest any of that money. So I think that that is an absolute genius way of going about it, at least in my opinion. Obviously, I could be wrong about everything. Do your own research, but that's just my opinion. So anyway, I've talked long enough. I wanted to make a video about these because I do think that they're interesting. I do think they're worthwhile, but I do think that they do have some drawbacks that you need to understand. So that is what I wanted to bring up today. Like I said at the start of the video, if you got value, please like, subscribe, comment, check out those links below, and stay tuned for more.